Good afternoon. Welcome to the Fixed Income Analyst Society meeting with Bloomberg Intelligence. I'm Ralph DeCesar, Head of Credit Research at TD Asset Management and the past President of FIASI. Before we get started, I just wanted to remind everyone of our annual Sustainable Finance and Fixed Income Conference coming up on Thursday, April 20th, all day, both in person at Fordham University's Lincoln Center campus, as well as available online. There are at least 10 speakers lined up, and we expect a very informative day. Please go to our website at www.fiasi.org for more information and for all things FIASI related. As for today, we welcome Bloomberg Intelligence, who have presented to FIASI several times before. They are one of the most experienced research teams on the street, as I've worked with some of today's speakers for decades. Joel Levington is head of the group, and he will take us through today's meeting. Take it away, Joel.
Hey, thanks, Ralph. And thank you so much, Ralph and Lauren. This is the 6th year we've had the pleasure of presenting for FIASI. And having had the chance to preview the slides, this might be the most informative one yet, likely because I'm not going to be presenting too much. I had the joy of meeting with several Bloomberg clients on the West Coast. I just happened to be in San Francisco when the Silicon Valley Bank collapsed. And the questions that clients were asking then, when will we see contagion in the market? What does it mean for consumer and commercial lending? And how do I find the opportunities through the wreckage are still questions that are being asked today. Luckily for me, our team, which was just 6 deep at the first FIASI event, now has 40 professionals around the globe with 600 names under coverage. And they're here today to help address these questions and your most frequently asked questions through the afternoon. We're going to go start with US banks because where else would you start? And as our team walks through not only what has happened, but more importantly, how do we think about the global financial institutions? And from there, our consumer and industrial analysts are going to discuss what the last few weeks have meant for their sectors, including healthcare, consumer cyclicals, and industrials. Now, energy has been somewhat of a safe haven this year, yet with natural gas prices plunging, Spencer Cutter is going to walk us through what we need to focus on going forward. And then lastly, we're going to wrap it up with a deep dive into TMT and tools on the terminal to help make sense of what's going on and how to screen for value. So with that, let me turn it over to Arnold Kakuda, BI Credit's US Bank Analyst, to start our first panel. Arnold?
Great, thanks, Joel. So if we could skip ahead to the US Banks section, that'd be great. If you can skip ahead, please. Yep, there you go. Banking turmoil and the ripple effects across the financials. If we turn to the next slide, we can see the damage that the turmoil has caused. On the left-hand side, we see that the financials, the orange and blue, which are the financials stock and bond indexes, those have plummeted, while the blue, which is the overall stock index, has gone down, but not as much. So things that we look at on the right-hand side, financial spread versus the overall IG index, that's widened out to about, it used to be flat in February, only a couple of weeks ago, and now they're about 25 bips wider, the financials versus the overall IG. If we skip ahead to the next slide, and then one more thing to note on that is these are bonds only. So this is not including any of this AT1 stuff, which has blown up in Europe, right, where Credit Suisse AT1s were wiped out, even though the equity got some recovery. So it does not include this stuff. So the real pain, felt by the investors are a lot worse than we're actually seeing in these, in these bond indexes. And then looking ahead to port, we see that the, total returns were positive, given the rates, overall base rates have come down, treasury yields have gone down, but spreads have widened. And the biggest US banks, if you look at the excess returns, they've been negative, but less negative in the overall. So that's been sort of a safe haven. Let's skip ahead to the next slide. Right, so on the right-hand side of the chart, over the past few weeks, things have widened, yes, but the biggest US banks like the JPM, they've been really a safe haven versus some of the regional banks, which we saw Silicon Valley Bank disappear in like 48 hours, right? So these other names like an FRC, First Republic, are still kind of teetering. So we're still kind of worried about what's going to happen there as well. And then the left-hand chart shows the relative stock performance as well. And we see that the bank index is down, but yet the bigger US banks like the JP Morgans have done a little bit better, while the concerned banks right now, which are First Republic and and to a lesser degree Western Alliance. If we skip ahead to the next slide. So really what this concern right now is that some of these select regional banks, they face some uninsured deposit outflow due to unrealized loss concerns. And basically on the chart on the left, you don't want to be on the top right. This is where these banks had a lot of uninsured deposits and a lot of unrealized losses as a percentage of capital, right? And so SIVB, that's the one that disappeared, Silicon SVB, they had a lot of unrealized losses and a lot of uninsured deposits. So when people got concerned, said, oh, there might be problems with SVB. Oh, and by the way, a lot of deposits were above $250,000 and uninsured. That's when the deposit outflow really accelerated. And so, SI is Silvergate. That's another bank that wound down. And then FRC, First Republic, that's one that got a $30 billion deposit inflow from the bigger banks. But they also have a lot of uninsured deposits. They serve a lot of wealthy clients, similar clientele, wealthy clientele as Silicon Valley Bank. So that may be teetering, and who knows how many more weeks before something happens with that bank as well. Now, there have been some things to help stem the outflow, but this BTFP is really a way for the banks to pledge additional collateral to get funding. They can pledge their debt securities at par, so they don't have a need to actually sell these securities for a loss right now. But it kind of only mitigates the pain, pushes it back for a year. Turn to the next slide. So, what are some potential cures? We think that deposit guarantees, those were only put in place for the uninsured, for those that have failed, right? And so we think maybe something like that for the next year or two might be, necessary for people to keep their money at regional. Not only just keep their money, but we need them to have we need that deposit flow to reverse, for some of these regional banks to have a chance. Right, the big winners here are we saw that the biggest banks, i.e. the JP Morgans, they took in the deposits that have flown out for some of these troubled regionals, and even smaller regionals at that. And then in terms of the regulation, we think more regulation is needed. The big thing here is that the biggest U.S. banks, these unrealized losses in their available for sale portfolio, the biggest U.S. banks have to recognize that in the regulatory capital. So yes, the P&L doesn't look good when they sell these securities, right? But it's already in their capital levels. Whereas all these regional banks, they don't have to, the capital levels do not reflect, regulatory capital levels do not reflect these unrealized losses in their AFS portfolios. Therefore, when there's deposit outflow and they need to raise cash to sell securities, it really hurts, right? It hurts them. They would only realize these losses and it hits the capital when they have to sell them. So it's this kind of cliff-like effect that I think was not good in these circumstances where these banks like Signature and SVB failed when there's a lot of deposit outflow. And then also the cure-all, I think, is lower rates, where the unrealized losses will get smaller, or maybe even turn flat if rates go back to zero, if we get a severe recession. If we turn the slide, please. And so then again, because some of these regionals have had issues, and then we're still so early, right? These are liquidity, asset liability management, basic kind of things. So we think the market is still kind of uncertain. It's banks, any bank where deposits flow out the door really quickly, it'll make anybody fall down. So basically, we prefer the biggest U.S. banks, even though spreads have widened. The biggest GSIBs have, like the JP Morgans and the Citigroups and the B of A's, they have the highest requirements in terms of capital, liquidity, and we think that's probably a safer haven to stay versus some of these regionals where who knows what's going to happen to First Republic in the next few weeks. So here we see on the left-hand side, they have a lot of excess. Right-hand side, we see they have a lot of excess capital. And the irony is, some of these guys are too big, so they can't, purchase these distressed assets from the sales of Silicon Valley Bank or Signature, right? Even though they have the most extra capacity. So some of them are too big to acquire. Some like a Wells Fargo have an asset cap, and the Citigroup also has to get permission if they want to do M&A, given their kind of compliance issues. If we turn to the next slide, here we see that the liquidity. This is the big thing where liquidity, liquid assets of the biggest US banks on the right, those have really gone up from the pandemic. That's really a function of, if you look at the left-hand chart, it's really and with the pandemic, 2020, a QE, a lot of cash in the system. So the solid bars, the deposits, right, went up drastically. Meanwhile, the dotted lines at the bottom, the loans were just anemic, if not going down a little bit. Now that has really reversed in the past couple of quarters, given quantitative tightening and rate rises. So that's what we've seen. Even the biggest banks, right, deposits have come down and loans have gone up a little bit, but still, the difference between those are really large, and that's why we have a lot of liquid assets lying around. So we think that is at least healthy, but we're seeing things normalize now. Yeah, so our preference is we think that the biggest US banks probably remain a safe haven. And then speaking of haven, I'll turn it over to my colleague, Dave.
Okay, thank you very much, Arnold. Nice, smooth segue there. Good day, everybody. It's good to be with you all again. I'm going to talk about alternative asset managers and their affiliated lender business development companies. Both areas experienced intense interest of late, well before Silicon Valley Bank imploded, I would add. If you can flip over to the next slide, that'd be great. Both areas, in our view, face a double-edged sword. Higher interest rates, the consensus seeing a 60% probability of recession, less conducive capital markets are obvious negatives. But they are at least partially balanced out by the 7 large alternative asset managers depicted in this slide, having $600 billion of dry powder as of year-end 2022. The ability to deploy this dry powder, presumably at lower valuations and with less competition, gives them a real opportunity to take advantage of a down market and add some assets at more attractive levels. Next slide, please. Credit investors tend to treat alternative asset managers with some trepidation. You can see that in the credit spreads here. In the belly of the curve, the alternative asset managers that we look at are generally rated in the A category, with the exception of Blue Owl. They generally trade, the A-rated ones generally trade in line with BBB financials, or maybe even a little bit worse. Out the curve, the alternative asset managers are about 25 to 50 basis points wide. Now, why is that? I'd say that there's a view that fundamental performance is closely tethered to market volatility. That's not really true. And that's not really true because these guys have grown so much fee-related earnings over the past couple of years that they have a much lower dependence on realization than they had in the past. I would also say that some folks simply don't want to invest in competitors. I think that that's something that'll probably continue to work against the spreads of alternative asset managers for some time. And I think in a few specific incidents, one or more of these guys may have run over a few other credit investors in a dispute. So there might be a little bit of bad blood, might be too strong a term, but there might be a reluctance to invest in some companies where you've had a bad experience with them. I'd say that that's a fairly isolated thing, but it is something that's out there. Next slide, please. Moving on to the alternative asset managers, affiliated business development companies, I think this is where things get really interesting. If there's trepidation around the alternative asset managers, there's a sizable contingent out there that, to put it plainly and bluntly, think business development companies might be accident prone at this point. That's understandable. BDCs specialize in lending to leveraged, non-public, usually middle market companies, and like I said, the economist consensus are looking at a 60% probability of a recession coming along, which isn't good for that cohort of companies. But BDCs are lending to a market segment largely vacated by the banks, thanks to Dodd-Frank and Basel 3.4. I started a chemical bank in a middle market credit training program back in the 1980s. That entire space is now business development space. The point is, despite big growth lending to the middle market, it's not a newfangled thing. There's been a lot of growth in direct lending and business development companies. People think that the next big thing to blow up in finance is going to be the thing that's been trendiest or has been growing the most rapidly over the past couple of years. That brings them to private credit, but private credit is not a new thing. It used to be done by banks. It's not done by banks anymore, or at least not the extent that it used to be. Business development companies operate with much less operating leverage. As you can see, those yellow balls on the left-hand chart, investments to equity runs about 2 times. That's a fraction of what you see at banks that are probably closer to 8 to 10 times. And there's been a lot of growth in the business development space. You can see that on the right-hand chart. The 12 BDCs depicted here saw investments nearly triple to $148 billion over the last 2 years. Flip over to the next slide, please. Business development companies are going off a cliff with credit performance, right? Well, not yet. If you take a look at the left-hand chart there, you can see in the blue bars where the total amount of non-accrual loans is a percent of fair value portfolio as of year-end 21. Gold bars are as of 2022. And a couple of the BDCs, Blackstone Private Credit, Blackstone Secured Lending, and Oaktree had 0 non-accruals as of both 2021 and 2022. So not yet. Credit performance is not going down, at least not yet. Now it is a lagging indicator. We understand that. We expect losses to filter through, but exposure to non-accruing assets remains modest, even 0 at some BDCs. Sponsors generally have skin in the game. Loan-to-value ratios are in the 50 to 60% range. How that value is calculated, I think, is probably open to some discussion, but that's where the numbers are as they're reported. BDCs generally have much better documentation than you get in the public market. That provides flexibility to recast loans if need be, with a good degree of flexibility. Finally, as you can see on the slide, while BDCs go down market in quality, they tend to go up in structure, with most holdings at most BDCs in senior first liens. Next slide, please. I would be worried if BDCs were facing a liquidity wall. They are not. There's less than $1 billion of BDC debt coming due in 2023, less than $5 billion in 2024. And meanwhile, BDCs generally have ample access to liquidity via their committed bank revolvers, which all extend 3 years or more. And those red bubbles on the right-hand chart show you the amount still available under their bank credit facilities as of year-end 2022. In addition to that, BDCs generally also have access to secured funding lines. That would obviously prime unsecured holders, but it would provide liquidity in a pinch. Next slide, please. To channel Rodney Dangerfield, how about a little respect here? Triple B range BDCs generally trade about 200 basis points above triple B financials. You may decide you're not being paid enough to own BDCs. I would disagree, but to each their own. But BDCs do offer enough yield that you are being paid enough to do some work on the segment if you haven't already. And if you want to do some work and bounce ideas off of us, happy to do that. And with that, I'm pleased to pass the baton on to my good friend and colleague. Give it up for the one, the only, Himanshu Bakshi.
Thank you, David. Good afternoon, and thank you for joining us today. My name is Himanshu Bakshi, and I cover global banks and US financial companies for BI. Today, I'll talk about the impact of recent market stress on US card issuers and Canadian and Australian banks. Please go to the next slide. So starting with US card issuers, we think that if the recent banking crisis trigger a lending crunch and economic recession in the US, that could hurt borrowers low on the credit spectrum and the card issuers with high exposure to them. And so the question is how prepared these card issuers are. Well, most card issuers' reserves already assume a mild recession and unemployment rising to about 5%. So a deep recession and a deep and a prolonged recession may require them to add more reserves. But for now, looking at the data from last month, Feb, credit normalization is continuing as expected, with delinquencies rising faster for card issuers with more subprime exposure like Capital One and Synchrony Financial, and more slowly for prime borrowers like Amex. So based on what we are seeing now, we maintain our view that net charge-offs may only reach historical levels this year, barring a deep recession. Next slide, please. So another concern that investors have is about card issuers' deposits. So deposits have grown to be the primary source of funding for US card issuers, which is a big change since the global financial crisis. However, they originate deposits online, so they may not be as sticky as relationship-based deposits at traditional banks. But we still see a low flight risk for deposit at these well-established franchises with really strong credit profiles. And also uninsured deposits range from 10 to 24% of card issuers' total deposits, so much lower than regional banks at about 40 to 60%. We saw that in one of the charts that Arnold presented. Next slide, please. Now let's look at Canadian banks' additional Tier 1 or AT1 notes. And the banks started issuing what we call limited recourse capital notes or LRCNs a little over 2 years ago. And these are investment grade and qualify as AT1 capital and rank equally to preferred shares and are senior to common shares, which means if a bank reaches a point of non-viability, LRCN holders will not experience a complete loss, what we saw with Credit Suisse COCOs, but instead will receive common shares. And most importantly, the Canadian bank regulator recently confirmed that common shareholders would be the first to suffer losses, followed by additional Tier 1 and Tier 2 bondholders. And therefore, we don't see a similar outcome for Canadian banks' AT1s, like what we saw with Credit Suisse. Next slide, please. Next, let's look at Australian banks' AT1 notes and see how they are different compared to those of Credit Suisse. So first, Australian banks' AT1s are rated higher than Credit Suisse COCOs. Second, Australian banks' AT1 securities rank senior in right to the obligation of holders of ordinary shares in resolution. Third, unlike Credit Suisse, CS, Aussie banks' AT1s have an equity conversion feature. So their AT1s are subject first to conversion into ordinary shares and then write down if banks' common equity Tier 1 capital ratio falls to 5.125% or below, or at the point of non-viability at the regulator's discretion. And final and the most important point I'll make is that Australian banks have ample capital cushion above their AT1 triggers, about 30 billion on average. And therefore, we think that Australian banks' AT1 notes have very, very low probability of distribution risk and non-viability or capital trigger events. And with that, I'll pass on to my colleague, Mike Holland.
Thanks, Himanshu. This is Mike Holland. I cover healthcare credit here at Bloomberg Intelligence. If we could just jump to the next slide, please. So healthcare credit so far in 2023 has been recovery focused, I would say, following a year in 2022 where we saw some serious distress enter the sector. If you look at some of these bonds, there are idiosyncratic credit stories that drew down prices of bonds, while at the same time, the rising rate environment brought down some of the performing credits that just had refinanced some of their bonds during the post-pandemic liquidity boom at coupons that in a rising rate environment really didn't make sense. I could point you to the right side of the chart where DaVita has 3.75% notes there that are now trading around 8%. So they're trading in the low 80s. I would say, looking back into 2022, there was a fear broadly that in this, potential for an upcoming recession, we would see healthcare exposed to higher risks than the sector historically would be focused on. The idea that healthcare as a corporate sector was defensive and resilient in a recessionary environment was something that was pretty common for a number of years. I would say that changed between 2010 and 2015 as consumers and individuals became more exposed to co-payments or deductibles that were rising much faster than the cost of care. So when an individual has a first out deductible that's a sizable amount, the sector is no longer really truly consumer non-discretionary. And so that's been increasingly risky sentiment around the space today. I would also highlight on this chart, we've got some names that are very topical. One in particular is Bausch Health, which is one of the largest issuers in high yield that is undergoing a spin of Bausch & Lomb, which is going to leave the RemainCo highly exposed to one drug that is coming up on a patent expiry. So those bonds have been trading the unsecureds in the 40 cents range for a number of months now. We also see Envision and Team Health and Air Medical, as well as US Renal and some of these other names that are exposed to changes in reimbursements as well as surprise billing issues. So a lot of the high yield space is now trading at distress levels, and we think that over time that could normalize for some of these names that are not at risk of default or liability management exercises that might result in discounted debt buybacks. Next slide, please. As you can tell here, these two charts are compilations of IG and high yield. We are seeing a meaningful increase in downgrades versus upgrades. For both Moody's and S&P, the trend has picked up over the last several years. You can see back in 2020, there was actually a significant switch to upgrades as liquidity flooded the markets. But that has changed obviously over time, and we are seeing a significant uptrend in downgrades. Moving on to the next slide. One of the big issues in healthcare across the consumer space as well, but just in healthcare in particular, is labor costs. It's been impacting hospitals in particular. As we've seen here, the cost of labor going back to 2020 really picked up across a number of different healthcare subsectors. Broadly speaking, we saw, the average, cost growth for labor, the low to mid single digits really pick up to the high single digits and even double digits in some cases. That has seemingly normalized a little bit toward the end of 2022. In particular, we've seen a significant drop off in psychiatric hospitals, benefits companies like Acadia Healthcare, as well as drop off in outpatient care centers, where you're seeing a lot of procedures migrate toward from traditionally the inpatient setting. So a company like Surgery Partners that operates strictly outpatient is now seeing a benefit there. I would say that costs are still elevated. Contract labor has declined, but costs are still elevated, and so margins have remained a little bit under pressure, but the pain has lessened a bit. Moving on to the next slide, please. So like many sectors in high yield, liability management exercises were undertaken, especially during the time of flowing liquidity during 2020 and 2021, that allowed a lot of issuers to address near-term maturities, so that in the healthcare space, particularly for high yield, in 2023, we really only have two issuers remaining under my coverage. One is Teva, that has about $2 billion upcoming, as well as Elanco, which has about $344 million due in 2023. In 2024, Teva's got the majority of that $5 billion maturities, and then we jump up in 2025. The 2025 numbers have chipped away. Actually, over the last 6 months, they've come down about 4 billion, and we expect that the companies will be addressing longer dated maturities opportunistically. And as for now, near-term refi risk remains low. Moving on to the next slide, please. Here's just an interesting chart we put together for both providers and pharma. Basically, it shows the blue lines are margins from 2021, and the orange lines are expected margins from 2024. As you can see on the left side, margins for hospitals have increasingly declined for 2024 as consensus estimates get revised, largely due in part to labor costs rising. Conversely, on the pharma side, which is not subject to the same labor cost pressures, we see a mixture of a little disparity in some companies expanding margins, with some companies seeing margin declines. Again, these are based on consensus estimates for 2024 versus 2021 actuals. Moving on to the next slide, please. On the payer side, which actually is probably the most resilient of the sectors under my purview, or the healthcare sectors under my purview, we've seen normalization for debt to capital ratios as some of these large managed care providers have undertaken significant M&A over the past several years. They've brought debt levels back to close to normalized levels. Even with recent deals, we've seen United Health announce several billion of transactions, as well as CVS closing Signify today. The company's debt levels have been managed skillfully, and they will probably not be subject to near-term ratings pressure as a result of many of these deals. On the other hand, medical loss ratios have normalized back to normal levels post-COVID, when a lot of care provision was deferred or delayed. And so the managed care providers had a real bump in earnings as a result of not paying out any medical benefits. So those are back normalized to levels more in line with historical averages. I'd highlight that Centene and Molina are focused on Medicaid. They have the lower medical loss ratios. The higher medical loss ratios, I'm sorry. We are expecting Medicaid redeterminations to roll off, and we're going to see a significant roll off in Medicaid enrollees in coming months as the public health emergency from COVID has ended. And so that could pressure those Medicaid payers, I'm sorry. Moving on. So these last couple slides just show some of the bond curves across the space. Providers in particular, we see HCA is best in class industry bellwether with recently rising star status shown in its bond curve. Wider from them are Tenet, which is the pink bubbles here, as well as Community Health. Those are Community Health's first lien bonds. Unsecureds and the seconds are trading off the chart. That company is struggling to generate positive free cash flow, and there's pretty wide divergence in hospitals, and it's really dependent on geography and location and payer mix, depending on the areas where the hospitals operate. HCA is obviously here best in class, and we expect them to continue to be resilient given their market share strength and capital levels. Right now, liquidity is very strong with them as well. Moving on to the next slide. Looking at pharma bond spreads here, we actually exclude Bausch Health as well as Endo, which are trading distressed above 1,000 per Marty Fritzon's definition. What we're seeing largely here are companies that have exposure to single drugs or don't have a fair amount of growth baked in, are generally trading at the wider ends. In particular, you see Elanco, which operates in the animal health space. They've been using revolver and term loan to basically fund small acquisitions, and they've been growing their debt load, and leverage is actually increasing. Teva is actually performing fairly well. As they're sort of at the wider end of the peer group here, but they've been very effective managing down costs. And although they're wider among the peer group, they are generally performing well as well. Moving on to the last slide, I believe. Here's our payer slides. They track, if you go back to the other slide, you can see that they generally track MLRs. So if you look at Molina and Centene, those are the Medicaid exposed payors. Molina is top of the heap here, not too wide though, at 270 over across its curve. Centene, which was upgraded to investment grade, saw some significant tightening at the front end of its curve. Prior to its upgrade to investment grade, it was trading around 200 over on the 4 1/4s and the 2.45 notes. Those compressed, but the longer dated bonds have not yet. And we think that will we think that the company and the bond curve will remain resilient throughout the course of 2023. Also, in a rate environment like we're in today, rising rates, we think that some of the larger managed care providers are going to provide a degree of resilience relative to the other subsectors under our purview. I believe do we have one more? Oh, we're passing it on to Jody, our esteemed leisure, lodging, and gaming, restaurants, and rental cars credit analyst. Jody?
Thanks, Mike. I appreciate the turnover, and thank you, everyone. I am so excited to be here and to cover a sector that some would argue was the most fun during the pandemic. I will say that for 2023, we're seeing many positive forces to combat the looming recession risk, and among them is the psychology of the consumer. They want to go and do. They're tired of being stuck inside, and they want to just have those experiences to go on the cruise ships, to go to hotels, to go travel around the world, go to Japan, as some of our colleagues are doing right now. That's finally holding true as well for the business and conference portion of the space as well. We're starting to see a return in conference travel and business travel. And on top of that, China's zero COVID policy is finally lifted as of January. So that's helping a lot of the casinos which were affected in Macau. That said, there are still the recession risks that are looming over the sector. At the end of my presentation, you'll see my coverage universe, which you can ask questions on as well. So let's turn to slide 36, please. So if you notice on the chart, one back, sorry. Yep, there we go. So if you notice on the chart on the right, as we just mentioned, people are still spending. They're both spending on food and they're also spending on recreation. Spreads, however, are signaling that market risk is looming and that bank headlines and lagging pandemic effects and the inability for some companies to return to normal are still very prevalent. And we're seeing that in the gaming sector. And as I mentioned, the Macau tailwinds are very nice, but at the same time, the risk of a recession still overhangs the sector. Comparatively, if you look at restaurants and lodging companies, they've been able to bring back their balance sheets in such a way that they're at their pre-pandemic levels and they're starting to issue share buybacks and dividends similar to what we saw pre-pandemic. On the left-hand side chart, we used our transcript analyzer on the terminal to look at companies and what their main sort of concerns are. And something that popped up last year very significantly was the discussion of a recession, which many of my colleagues have talked about as well. Interestingly enough, however, wage and labor costs have dropped, as Mike Holland spoke about as well in his sector. And part of that is because of the consumer spending and the ability for companies to push on the cost to the consumer. Unlike wage and labor costs, we see that supply chain and input costs are still weighing on the companies. And so inflation is still very much an issue for a lot of these companies as they're trying to get back to normal. Pent-up demand remains a bellwether of topics that help companies buy, whereas leverage is something that they're still focused on. And not shown on the chart is also cash flows, which have come back in fold as a topic that companies care about, both because they're either seeing very strong cash flows or because they're driving themselves to get to positive free cash flow, as some of our companies are talking about. 2 slides from here, please. Thank you. So many of the companies in our sector are stabilizing or improving from a credit ratings perspective. We are seeing way fewer red dots on our charts than we saw, say, a year or especially 2 years ago. So a lot of the companies are starting to improve. They're showing signs of improving. We're not necessarily seeing full turnaround stories just yet. And some of the companies like the cruise lines, which we like to pick on occasionally, as well as the casinos, are still very much in that turnaround, that early turnaround phase, and are still dealing with some of the debt that they took on from the pandemic, or are dealing with these sort of macro forces as well as individual company forces that are weighing on their outlook. Please turn to the next slide. So what does that mean from a margin perspective? Well, for 2023 and 2024, we're seeing margins get back mostly to 2019 levels, but some of the factors like inflation are still weighing on these companies' outlooks. And the other factor is, and this is a slide that you'll be able to see in the presentation, but we skipped over for time, is that companies have a lot of job openings at the moment. They're trying to hire, and so some of the revenue might be left on the table as a result of the fact that they can't find enough people to actually do work in their industries. So that might be weighing on margins a bit. Next slide, please. And so what are we talking about for the high yield portion of our sector? Well, high yield obviously is the riskier portion of our sector, and we're seeing the outlier being the leisure space, which we talked about the cruise lines. Theme parks are actually doing quite well. They've turned around, they've been generating positive free cash flow, and they've been seeing almost record mission levels at this point. That said, the risk related to the ability for these companies to get back to normal and do it in such a time that should a recession happen and should the consumer sentiment still stay where it is sort of a question mark in our view. I think there's a lot of promise in the sector, but I also think that there are a lot of negative factors, the biggest one being market liquidity, which, should it dry up, is a question of how these companies sort of manage over the next few years. It's really a case of timing at this point. If the companies are able to get back to normal before or after consumer sentiment changes. So are people going to continue to spend, or are people going to start tightening their purse strings such that they pull back on services, not just on goods? Next slide, please. So what's most interesting when thinking about companies and thinking about the timing perspective is the massive amount of debt that they issued in 2020. We saw, 86 billion of debt issued in 2020. That's that bright pink line on our chart. And you compare that to 2021 and 22, where a lot of companies took that debt and then refinanced it to push it out. There's still some of that happening, but we do have a lot of companies trying to lock in new debt as soon as possible. So case in point, not to pick on the cruise lines, but I'm going to pick on the cruise lines. They've actually issued future revolvers, meaning revolvers that don't go into effect until sometime down the road, August of 2024 for Carnival, for example. And that's because of this rising rate environment. That's because of all the uncertainty that's weighing on the markets. Now, fortuitously, it was done before the bank situation developed. So it's definitely a positive for these companies not to wait. And I think we're going to continue to see that companies are going to jump at every opportunity to refinance debt and to tap the debt markets as much as possible. Now, next slide, please. So now how are our companies using their cash and spending their cash? Well, we're seeing that spending and using are the same thing. We're seeing that in 2020, companies actually built a nice stockpile of cash. That's that light yellow line that we're seeing over there. Comparatively, they also issued a tremendous amount of debt. Now, they did pare back their equity buybacks as well as their dividends. And so we saw that instead there was actually a lot of equity issuance. Now, 2020 is sort of an anomaly of a year if you look at it across the rest of the years. And instead, if you turn your attention to the right-hand side of the chart, you'll see that 2022 versus 2020 are sort of different kind of stories going on. So 2020, it's the same across the sector that you see companies are just building up their stockpiles of cash. They issued a lot of debt, they issued equity in some instances, and they did not give back to shareholders. 2022, we're seeing a lot of companies, so the pink part, we're seeing companies actually give back to shareholders this year in certain sectors. We're seeing some sectors like travel and tourism, which I have to note, Avis and Hertz sort of throw off the data there. there in terms of CapEx as well as in terms of givebacks. If you take them out of that segment, then you'd actually see a very different sort of story there. You'd still see that cash would drop. However, what you would see is maybe a lot more debt issuance, at least comparatively to what they're spending on CapEx. That is something to note in our sector, is that I think it's sort of a company by company story as well as a segment by segment. So different parts of the industry are doing different things at different times. So our lodging companies are in a spot where they're starting to think beyond just the balance sheet. Same thing with a lot of our restaurants. However, if you look at some of the sort of the companies that were most affected by the pandemic, they're still in this turnaround phase. They're still trying to get back to normal. And I think that you're going to continue to see that through 2023. However, the tailwinds of the consumer spending is potentially going to offset some of these headwinds related to market liquidity. So with that, turn to the next slide, please. And this is just our coverage universe. If you have any questions on them, I'm reachable on the terminal. And with that, I am going to turn over to someone in a similar camp to me. It's Mike Campellone.
Thanks, Jody. My name is Mike Campellone, and I cover investment grade and high yield retail for our USBI credit team. I'll start with some recent data points and charts that we believe reflect the state of the US consumer, as well as current spending trends we are seeing in credit card transaction data. Next slide, or stay on this slide, please. On this slide, you'll see the year-over-year quarterly change in US credit card balances, which we believe can serve as an evidence that the financial health of the US consumer is declining. The Federal Reserve Bank of New York said credit card balances increased 15.2% year over year in the fourth quarter of 2022, the largest increase in over 2 decades. And this may be a signal that consumers are resorting to credit card borrowing after depleting their stimulus-fueled savings during the pandemic. Next slide, please. Here we can see the year-over-year percent change in monthly spending from credit card transaction data, broken out by higher level industries on the right-hand side, with the retail sector being the pink line, and then the major subcategory drivers within retail on the left-hand side bar chart. The data in these images is as of February and indicates consumers pulled back spending in the month of February, with retail spending growth slowing to minus 1.3% in the month, and more in line with what we saw through Q4 of 2022, including larger declines in the retail subcategories that boomed during the pandemic, such as electronics and appliances, and furniture and home furnishings. Zooming out beyond retail, spending on travel, leisure, hotels, and restaurants remain the strongest industries on a year-over-year growth basis, supporting our view that US consumers may be prioritizing spending on experiences and services and deciding to trade down in retail categories amid high inflation. Next slide. Now, what does this potentially mean for US retailers? On this slide, you'll see some of the largest debt issuing retailers in the US and across the rating spectrum with current inventory levels versus their historical average. Retailers are still carrying excess inventory, a risk to sales and profitability this year as the financial health of the US consumer weakens and shoppers become increasingly more price sensitive. As supply and demand start to normalize and promotional activity to clear excess inventory eases, retailer margin improvement should follow. However, the impact of higher rates and lower savings on the US consumer could offset some of this margin recapture opportunity for retailers as they feel the impact of both cost-conscious consumers and rising costs amid high wage growth. Next slide, please. Spreads of the Bloomberg US dollar, IG, and high yield retailer indexes have certainly expanded to levels that capture some of this rise in credit risk for the sector. But as always, risk isn't equal for every retail issuer. Issuers where risk may be higher in our view include names like Kohl's and VF Corp, whereas for issuers like Target and Macy's, market implied credit risk may be lower. And now I'll pass it over to my colleague, Matt Geudtner.
Hi, everyone. My name is Matt Geudtner, and I'm a credit analyst here at Bloomberg Intelligence, covering aerospace and defense as part of the industrials team with Joel. Next slide. We witnessed passenger traffic last year rising to about 70% of 2019 levels, with that level likely continuing to grind higher in 2023, as some of the data highlighted by Camp showed, to 90% or more by year end, and fully returning to pre-pandemic levels next year, ahead of a more GDP-like growth rate in the out years. Domestic North America is leading the overall recovery in air travel demand, which is important for the likes of Boeing and Airbus to hit their delivery targets and potential rate breaks, as well as support the health of the aerospace supplier landscape. The OEMs are contending with issues related to supply chain and labor, which isn't going to go away immediately, but should ease as new hires receive training and the OEMs take action to boost visibility into those tier 2 and 3 suppliers, with cadences across the supplier base improving and leaving the space as a whole in a better position now than what we had saw this time last year. Next slide. With that in mind, I'm looking at plane maker Boeing and aerospace supplier Howmet. For the former, repairing inventory by delivering planes, generating cash, and cutting debt are the key catalysts for spread tightening, as such actions would improve or provide some much needed relief for the company's strained financial risk profile, and are sort of key to narrowing the discount at which some of the OEM's bonds trade relative to BBB tier peers. Boeing should address the remaining $3.4 billion worth of maturities this year with cash on hand, with a mix of maturing or callable bonds through mid-decade that represents an opportunity to sort of meaningfully deleverage their balance sheet by paying down up to $20 billion worth of debt and keeping hold of their high-grade status. Next slide. All three raters, Moody's, S&P, and Fitch, all expect dividends and buybacks to be suspended through 2024, or at least until funded debt is significantly reduced, which means the $17 billion of cash on hand they had at year end, in combination with cumulative cash flow that may exceed $20 billion through 2025, should be used exclusively for debt reduction for at least the next few years. We've tried to illustrate this using Bloomberg's Terminal functionality, which incorporates Boeing's sources and uses of cash, as well as the consensus forward outlook. Next slide, please. Their cash position may drop to about $11.5 billion by mid-year, as $5 billion of bonds mature for the full year this year. Yet they'd still have about a 15% buffer versus the minimum of $10 billion that management wants to keep on hand, as well as what Moody's and Fitch contemplate over their rating horizons. And so despite the cash call, liquidity is bolstered by $12 billion of availability under credit lines, with cash flow that you can see here is sort of heavily weighted to the second half of the year, and really important in positioning the OEM for further debt reduction next year, utilizing excess liquidity. Next slide, please. And then lastly, turning to relative value, you can see using our FIW, the fixed income worksheet function on the terminal, the rising trajectory for earnings and cash flow for them in 2023, we think could help close the 25 to 40 basis point discount for some of the bonds as compared to where they trade versus BBB tier peers over the intermediate term. And that outlook coincides with appetite for Boeing's bonds, which total about $50 billion in the US Ag Index, rising at the second highest rate among investment grade peers. And that's its default risk has fallen to 8 to 9% since last summer. And so that scenario for spread tightening would be supported by our view of accommodative rater stances, rising deliveries, and cash flow that position them for far more significant liability management next year. Next slide, please. And for Howmet, we think they could be on a rising star trajectory with key financial risk metrics that may test upgrade triggers this year based on our analysis of the raters' methodologies. A crossover at S&P or Moody's would result in 2 investment grade rankings, given Fitch's BBB minus rating, and a potential catalyst to narrow the more than 60 basis point average discount at which its bonds trade through 2029. Improving sales and earnings in line with consensus for 23 would push adjusted leverage and FFO to debt ahead of the strong end contemplated by S&P for its base case outlook. And the chart here, we net cash against debt, which is in accordance with S&P's methodology, and assume shareholder rewards that are in line with consensus, which you can find on the terminal by running Howmet's equity ticker and then the function tail MODL. The favorable discount rate assumptions used to determine pension underfunding last year helped drive a 20% improvement in the liability, which is important for financial risk, given that the raters view the underfunding as debt-like and included in their adjusted debt figures. Then I'd note that Howmet's ratings are mostly financial, and so cash flow applied to further paired debt could help position them for potential rating improvement. Can you please turn the slide? And so we think that could leave Howmet's $4 billion of bonds better positioned to mirror expected gains in credit quality into next year, which would sort of catalyze the narrowing of the spread gap versus the BBB minus rated industrials denoted here in white. And that scenario assumes that they're able to generate around 1.4 billion of EBITDA and around 600 million-ish of free cash flow, while accounting for some post year-end debt reduction for its 2024 bonds. And as you can see on our FIW function, their curve is denoted here in pink, trades near to the BB tier capital goods peers in orange, and which includes issuers such as Embraer, with management signaling an expectation to refinance next year's maturity. And I'll pass it off to Spencer, who's going to talk some energy shop.
Thanks, Matt. As Matt said, my name is Spencer Cutter. I'm a senior credit analyst with Bloomberg Intelligence, covering the independent energy, midstream, and services sectors. With all the news these days about bank runs, recessions, and generally heightened concerns about a potential dislocation in the financial markets, I thought it'd be worthwhile to see how the energy sector is positioned for what may be another downturn. I'll just state up front that I think the sector actually is very well positioned at this point. Oil and gas companies entered 2023 with the strongest balance sheets and lowest leverage ratios in decades. We saw a wave of bankruptcies in 2016 and again in 2020, which have culled the weakest companies from the herd. And those that reemerged from bankruptcy and are still around have done so with significantly less debt. And finally, if there is a broader financial downturn or crisis, lenders will likely be attracted to sectors that have real assets that can generate real cash flow, for which there's a relatively robust M&A market where those assets can be monetized, all of which you can find within energy. On this first slide, as Mark Twain said, history never repeats itself, but it does often rhyme. So while there are many differences between the world we're in today and sort of 2007-8 financial crisis, there may be some similarities. So I figured we'd start there. As you can see, during the 2008 global financial crisis, oil prices plunged by more than $100 a barrel, from a high of 145 down to a low of about 34. And as one would expect in that environment, bond prices plunged, and the spread on the Bloomberg High Yield Energy Index jumped from about 425 basis points to just under 1,600 basis points. Next slide. However, you can see even with that sell-off, the energy market did outperform and was in some sense a safe haven in the high yield world. On this slide, we can see that even with the sell-off, the credit spread on the high yield energy index was more than 300 basis points narrower than that of the overall market. And I need to point out that at this point, the energy index, the Bloomberg High Yield Energy Index, did not include the midstream sector, which at the time was housed under the utility umbrella. Had midstream bonds been included, given that they're one of the safer, if not the safest, sectors within energy, that spread differential you see here would likely have been much wider. It may be worth noting that this chart goes back to 2002, and between then and 2014, the credit spread on the energy index was narrower than the overall market, but the largest differential you see in there was actually during the financial crisis. Of course, that dynamic changed in 2015 as oil prices started their march towards around $26 a barrel in 2016, and then essentially went to zero briefly in 2020. But since then, the high yield energy index has recovered and once again trades at a tighter spread than the overall market. Next slide. You can see where are we today? This is a high yield independent energy sector, and the credit spreads have narrowed as oil prices have started to recover since 2020. But they've basically remained range bound for the last 2 years, even as oil prices climbed from around $70 a barrel above 100. With increased focus on generating free cash flow to fund dividends and stock buybacks, most of the benefit that may accrue from oil prices above $70 a barrel is being steered towards shareholders, not giving much benefit to bondholders at this point. So it would make sense that there's a bit of a floor on credit spreads. And while we've seen some volatility over the past few weeks, spreads today are still well within their recent trading range. And from a longer term perspective, we're still near the lowest level that we've seen since the 2008 global financial crisis. So we're currently at a pretty strong point. Next slide. So with everything going on in the world, why are spreads relatively narrow today? And is the market just whistling past the graveyard? I'd argue no. The slide's a little bit crowded, but basically compares credit quality of the largest high yield independent energy debt issuers in 2014 and again today. As you can see, in 2014, before we hit the first of the recent energy downturns, 7 of the 10 largest issuers generated negative free cash flow. The average leverage ratio is about 3 times, with some ratios well north of 4 times, and the debt per 1,000 barrels of oil equivalent produced was north of $100. Fast forward to today on the right, many of the companies on that list in 2014 have gone bankrupt and then disappeared, wiping out billions of dollars of debt. Others have used free cash flow and asset sale proceeds to pay down debt. As a result, only 1 of the top 10 companies is expected to report negative free cash flow this year, and only a very modest amount at that. The average leverage ratio is expected to remain well below 1.5 times, and the debt per BOE produced is expected to be below $40. So the sector is in a much better shape today to weather a downturn. Next slide. From a fundamental standpoint, where should we start to worry about lower oil prices impacting cash flow and production? This is admittedly a very high level analysis, but if you take a look at the all-in cash cost profile for some oil producers, many are in the $30 to $40 per barrel of oil equivalent range. When you compare that to their realized average price per BOE produced, it would imply that for the lower cost producers, they should be able to support a CapEx budget that can be funded from cash flow that enables them to at least maintain production with oil prices of around $50 a barrel or more. Some of the higher cost producers may need something closer to $60 a barrel. And I should point out these are ballpark ranges, as there are a lot of variables and levers that can be pulled. Most companies produce a mix of oil, natural gas, and liquids. And a higher price for one commodity can obviously help support a lower price for the others. Also, if commodity prices were to fall, that would likely lead to reduced drilling activity, which in turn would enable producers to get a better deal on their drilling and services costs, thereby lowering their maintenance CapEx hurdles. But this at least gives you an idea of where the break evens are. Next slide. Just to drive the point home that the high yield energy sector is well positioned for a downturn, let's look at what's going on in the natural gas sector today. Many natural gas producers started to cut back on their commodity price hedges in 2022 as they longed for the cash flow that they could generate with prices that at that time were in the $5 to $9 range. The timing was, of course, perfect since August. Natural gas prices have plunged by about 75% and are around $2 today. And I think they actually briefly touched below $2. Yet, while credit spreads have widened a bit over the past month, they really are no worse today than they were in June or July when natural gas was north of $5.50. On the next slide. So why? Well, even with a downturn in natural gas prices, analysts seem to think that credit quality within the sector is likely to remain relatively strong. Most producers are expected to end this year with leverage ratios below 1.5 times, and none are expected to be above 2 times at this point. Again, many energy companies have been focused over the past few years on paying down debt and building stronger balance sheets, so they should be well positioned to ride out the downturn for at least 12 months, even if they don't have a significant level of commodity price hedges to protect them from that downturn. That said, if we get to the end of this year and it looks like natural gas prices could remain stuck below, say, $3 per 1,000 cubic feet well into next year, things could start to get a bit more interesting, but for now, it doesn't look like there's any reason to pull the fire alarm. So as I mentioned at the beginning, energy companies entered the year with the strongest balance sheets and lowest leverage ratios in decades. Multiple downturns since 2014 have culled the weakest companies from the herd. And if there is a broader financial downturn or crisis, given where we're coming from, lenders will probably want to avoid, crypto, vaporware, new tech borrowers, and instead will be attracted to the old-fashioned industries and companies that have hard assets and have long track records of generating real returns and real cash flow. And with that, I'll conclude my remarks and pass the baton on to Mr. Flynn.
Oh, fixed it. Can you hear me now? Sorry. So again, my name is Steve Flynn. I cover the communications sector for Bloomberg Intelligence, both investment grade and high yield. High yield communication is pretty much the opposite of Spencer's energy sector, with a lot of names having weakening credit profiles and a lot of distressed credits, whether we're talking about Lumen, DIF, Altice USA, Consolidated Communications. There's plenty of those. We have a lot of stuff out in the terminal for you to read if you're interested. But let's be optimistic today and talk about an improving credit in the communication space, and that is Netflix, which is a rising star. I'm going to talk about how you can use Bloomberg tools to help think about valuation. So when we look at Netflix, the question is, are the spreads tight or just right? So next slide, please. All right, so just a quick credit snapshot of Netflix. Netflix has almost $9 billion of US dollar denominated bonds. They're unsecured. They mature 2024 to 2030. They are BA1 with a positive outlook by Moody's and BBB by S&P. However, they need 2 IG ratings to move up into the Bloomberg investment grade bond index. And Netflix reports 1Q results on April 18th. So hopefully that will be the catalyst for Moody's to upgrade the company, and then we'll be full on IG. Netflix credit profile is very strong. Net leverage is in the low 1x area. The company returned to subscriber growth in the second half of last year, and they have very conservative balance sheet goals, which they reiterated many times, including gross debt of $10 to $15 billion. They're within that range, and a minimum cash balance equal to at least 2 months of revenue, which is about $5.4 billion. The last release from Moody's was almost a year ago now, saying they wanted to observe for a couple more quarters to determine if their subscriber issues have been fixed, and the company is ready to be upgraded, and hopefully we'll get there soon. Next slide, please. So the best way to look at relative value in the terminal is to use our fixed income worksheet function, or FIW. And so what we have here is looking at Netflix relative to all companies that are rated BB by Moody's in the high yield bond index. So at the top left, I put the ticker for the Bloomberg High Yield Corporate Bond Index. I selected, let's look at all bonds rated BB by Moody's. And since it's high yield, let's look at option adjusted spread by bid years to workout date. And then what we could see is the yellow curve at the bottom is the Netflix curve. The white curve is the regression curve for all BB rated bonds. And you can see Netflix trades at a significant premium, well inside of almost every company there, and definitely inside the regression curve. And again, given it's a rising star and given it's a very solid credit profile, that makes a lot of sense. But then the question is, okay, so then what happens once it's upgraded by a Moody's? So next slide, please. So what we can do is we can use the terminal here also. So first we could start with the search function, the bond search function, SRCH. And here's the criteria I put. I want to see all bonds, all dollar bonds within the communication sector that are rated BBB by S&P and are within 10 years. Next slide, please. So that's my search function. I came up with 220 bonds, and then I could send those search results over to that FIW screen. And this is now all the bonds that I set forth, and now what we can see is given its IG, we're looking at G spread versus maturity, and we can see the Netflix curve is right on top of the investment grade BBB curve. So one could argue that if Netflix gets upgraded by Moody's, the spreads are pretty much in line with its peer group. Now, you could argue also that Netflix's credit profile may be even better than some of these BBB rated companies, but to start with, the spreads look pretty much in line. So that's 2 examples looking at Netflix as part of the high yield index, Netflix, how it compares to likely future comparables, BBB companies in the investment grade index. And with that, I'll pass it over to my colleague, Rob Schiffman.
Thanks so much, Steve. The good news is we're almost done. The bad news is you have me for our last segment. I'll be focusing on the terminal's portfolio and risk analytics function, better known as Port. So to be clear, before I came to Bloomberg, all I knew about Port was that it was a great drink to enjoy after dinner. Now I use it every day as part of my research process. The function, not the drink. I'm Rob Schiffman. I cover all things tech credit from IG to high yield, software to hardware, semis to social media, and everything in between, which can often be a real challenge as I struggle to find the right comps and where to find comparative data with such a diverse and heterogeneous coverage universe. As a backdrop, I'm bullish on my coverage with opportunities to both pick yield and increase defensiveness. As both macro and micro uncertainty has risen, the tech space remains a safer haven, supported by $1 trillion in cash. My colleagues make fun of me all the time about talking about cash, but $1 trillion of cash, abundant free cash flow, long-term improving secular dynamics. And unlike a lot of our other analysts who are showing lots of red dots or yellow dots, to me, they're more stable to improving ratings profiles. If we can pop to the next slide. Steve just walked through a great example of highlighting key data points within FIW. I'm going to take a quick deeper dive into additional functionality via port using a variety of preset and bespoke settings, as well as a variety of indices as examples. You know, answering a simple question like what is a tech company may seem super simple. And whenever anyone's looking at new issues and trying to come up with the right comps, you know, sometimes it's not as easy as said as done. You know, how you define a sector might not match how the index you're measuring defines a sector. For example, as you can see on this slide, I cover all these names, yet only Apple, Microsoft, Oracle, and Broadcom are defined as technology when pulling up the Bloomberg US Corporate Bond Index via Port's B-class specs. Amazon and Alibaba are classified in the consumer cyclical sector, as is Uber in the high yield index. So based on index specific requirements, to take it to a different, deeper level, in order to find a name like Tencent, you need to search the Bloomberg EM USD Corp Quasi-Sovereign Total Return Index to find results. It's near impossible. It's a super mouthful. And it's a challenge. This is where Port can really help simplify your process. Next slide, please. On this chart, I just simply highlighted the high grade index, which is displaying total and excess returns by sector. The data provides a real easy comparison via multiple performance measurements to see rel val corresponding to any time frame you choose. In this case, we can see the tech sector has outperformed the broader index this year via both total and excess returns. Next slide, please. Another cool, more detailed option I use is the ability to break down each issuer or even individual issue to see each component's CTR or contribution to return. When trying to figure out which names or bonds are moving the sector's composite return needle, this type of tool really helps differentiate which names are outperforming and underperforming and having the biggest and least biggest impacts, which really help me target and focus on the stories and bonds that matter the most. Next slide, please. Yet another way to think about which issuers may have the biggest impact on sector performance is sorting their index market value and percentage weighting within the sector. In this case, it's clear that Apple and Oracle by far have the most bonds outstanding. You can drill down even further by clicking on the ticker and pulling up each issuer's individual bonds and their performance and weighting. Next, please. When digging deeper into relative val, our starting point is typically identifying the right comp. So how do we go about doing it? Usually we're going to start with port to see what subsector of the relevant index the name you're looking at is housed in. What I really love about this function is it provides a gateway to other tools, including FIW, RV, CRVD, and COMB. We have a BI cheat sheet for detailed explanations of what all this terminology is. In this particular case, I use Port to identify total high-grade returns for 2022. That's the red on the left. Then went to the next level deeper by selecting the tech sector on the right, changing the date to year-to-date 2023 returns, and utilizing the auto heat map charting tool to break down by issuer, issue, and relative size. Though I covered the whole credit curve, my tech coverage focuses primarily on high-grade names. And though port may default to total returns, it's easy to customize your view to include excess returns. In this example, it appears as if 2022 is a complete disaster with double-digit declines across most sectors. Yet for high-grade PMs and analysts that hedge and look primarily at spread moves, we'd note that excess returns, though still negative last year, were much more muted on a relative basis. And with just one additional click, I could get more granular and break down by issuer and issue, something I'm doing on a daily basis. And one more slide for me, if we can move on. Just to highlight how versatile port is, it's not just a pure credit return status report. Effectively, any Bloomberg index you're interested in can be utilized, all with the same level of simplicity and detail, all of which you can make bespoke to your needs. In this case, I'm looking at the convertible index, which matters in my world because, as you can see, the tech sector makes up almost a third of the index. So as tech goes, so goes convertibles. Next slide, that's the end. Why don't I turn it back to Joel for some closing remarks and any Q&A if there's. Joel?
Yeah, thanks, Rob. We were actually able to take care of all the Q&A behind the scenes. So thank you, everybody, for the questions. As you can see, I wasn't kidding. The slides are terrific, and as is the insights. For people that are interested in replay, since that was a question that came up a few times, that'll be on the fiazi.org website, as will a copy of the slides, or if you need them more rapidly, you can reach out to any of the analysts or myself for a copy of them. And also with any additional questions going forward, certainly feel free to reach out to any of us. In the meantime, thank you, Fiazi, and all your constituents, and we'll see you again soon. Thank you. Bye.